Good morning and welcome to the NetScientific PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to Ilian Iliev, CEO. Good morning, sir.
Thank you very much, Lily, and welcome everybody to this IMC presentation on NetScientific's 2023 results and an update since then. My name is Ilian Iliev. I'm a CEO of NetScientific. I'm also joined by my colleague Ed Hooper, who is an executive director at NetScientific and general counsel. I will take you through the presentation. There's a lot to cover this morning, and then during the Q&A to be both myself and Ed answering questions. Well, I think in terms of our audience, there will be some of you that have been monitoring our development over the last few years, and there'll be others that are just joining the story or considering to join the story. So I'll tell you a little bit about ourselves. So NetScientific is a deep tech and life sciences venture capital group. We have an international portfolio of innovative companies. Our business in its most basic form is to identify, invest in, build and exit innovative companies in the UK and internationally, and with a focus on companies in deep tech and life sciences. We have a high conviction and a big vision. We are aiming to become a leading VC investor in deep tech and life sciences, both in the UK and internationally. And as I go through the discussion, where we came from, where we are, where we're going, I hope you'll start understanding how we plan to implement our vision. There's a big moment for us now. We have now reached 100 million plus in assets under management with a mixture of direct equity and managed funds. Our portfolio has grown to 70 companies in the UK and internationally. And we're looking to build a sustainable platform so that we can get to our next milestone of 200 million assets under management. And as you see in the next slides, we are not a passive investor. We are a proactive investor that manages our portfolio in a very, very active manner, thus driving investor returns. I want to recap again what our operating model is. We have been chiseling it and improving it in practice, working with our portfolio over the last 3 years. And we feel we have now something very special that has been proven with our portfolio. And we're now at the point where we can accelerate and scale significantly. Core to our model is what we call a capital efficient investment strategy. Efficient as opposed to inefficient, but fundamentally we're looking at taking utilizing our limited balance sheet, either with cash or paper, or indeed just the presence of a balance sheet, but then syndicating third-party investments from our investor network and now our fund practice to support our portfolio and grow our portfolio. This is as opposed to using only balance sheet, which we find very expensive and very inefficient and not scalable. So this is something that we have developed over the last 3 years, and it's quite key, and you'll see the numbers in a second. The next bit is that once we're inside the business, we don't stay still. We have a very proactive portfolio management approach where we look for value opportunities to deepen our stakes, to improve our position, and to protect our shareholders' position. Beyond that, we've taken a leaf from the private equity playbook, whereby we provide value creation services to a subsection of our portfolio where we feel we have a big enough stake for it to matter, but also where the companies can benefit from our support. Importantly, we do this all of this on a fee-generating basis. We believe that we have to pay our way through life, and we want our target is to have an evergreen model where the operational income covers the costs of the platform, so that when entities are sold, investment returns come in. That is the upside. We'll show you how we have developed and achieved that. We've talked in the past about our ambition to launch a fund management practice. We have now done that, and that will provide going forward further scale and growth for our business, but also for PLC to provide opportunities to selectively take stakes and of course generate management fees to further support the platform. Around all of that, we're also proactive in driving our portfolio towards exits. We don't want to hold these companies forever. Ultimately, our objective is to generate shareholder returns through to the realization of these companies. Through all of that, because we have a front seat in this theater, we have the opportunity of deepening our direct stakes, building stakes in our portfolio companies, in turn increasing the likelihood of capital returns, in addition to the carried interest returns that we get from our fund management practice. We have built a tight, diversified, and effective team. Our board is supported by a broader team of people in the corporate finance space, investor relations, finance professionals, IP professionals, both people employed by us, venture partners and advisors. But all of that gives the scale for our tight board to do its job. I'm the CEO of the company. I was the founder of EMV Capital, which was acquired by NETScientific in 2020. I'm also a significant shareholder of the business, which makes it very much in my interest to make this a roaring success. And I've got experience broadly in deep tech that I'm bringing to this business as we move forward. My colleague Eg is an experienced professional both in the legal and corporate finance space. He's a lawyer by training. He has 20 years of experience in M&A, fundraisings, IPO in the UK and internationally. And us together are in a really good position to drive transactions and protect our businesses going forward. On the non-executive side, Dr. Charles Spicer is our chair. He's quite well known in the city. He previously headed healthcare at Nomura and Numis. And Jonathan Robinson, who is a material scientist by background, but he has also built and sold businesses successfully, bringing his expertise to that. Finally, supported by Stephen Crow, our CFO, an experienced finance professional. We have a core portfolio group that is diversified both in terms of sectors and geographies. We have portfolio companies in the life sciences space, in the deep tech and sustainability space. And these range from publicly listed companies, PDS Biotech, which was a university startup some time ago. It is now a company with multiple successful phase 2 trials, looking at the phase 3 in the immuno-oncology space. But then we also have companies such as Deep Tech Recycling, bringing innovative solutions to the recycling of plastic waste, a massive global problem, or Sofan Technologies, taking semiconductors in the SATCOM space, building what we believe will be a UK champion in satellite communications, a major growth area. We have gradually built and developed this portfolio. We know the companies quite well. We have a mixture of direct and indirect stakes, giving significant exposure to returns. Now, some of you might have noticed that post-balance sheet, we announced the takeover of the fund management of Martlet Capital. That is an early stage VC fund, quite well known in the Cambridge community, that is really good at spotting companies in the early stage and then building a stake into them. So they have now joined our family, and together we are now a 70-plus portfolio company. Here is a subset of the Martlet Capital portfolio businesses. We're not going to be deeply involved in all of them, but it gives a much broader opportunity set for NETScientific in its investment model, while Martlet Capital drives growth in these companies and indeed looks to expand its investment program. So really a major step change in our development. Now I'm going to turn to some of the numbers, the financial operational highlights for the year ended 31st December. Our total assets under management have increased to over 74 million. In 2022, there was 69 million. Now, I must emphasize, it's venture winter out there. As you know, the venture capital industry is experiencing its most difficult period, certainly since 2008, perhaps since 2001. But we believe in situations like this, significant growth is possible, and we've taken the opportunity, we've taken the baton, and we have done a lot last year. Not everything is positive. The fair value of our direct holdings has decreased by 15% to 35 million from 42. That is driven primarily by the declined value of our PDS Biotech holdings. It is not fun to be a small cap biotech company in the US, but we remain confident in PDS's underlying value, and you would have seen some results that were announced yesterday that continue to show the underlying strength of that business. However, with our broader model, and of course we can make more impact in the privately held companies, that has been offset by a 15% increase in the fair value of our privately held companies, which is now 31 million, a significant number. Importantly, the fair value of the managed stakes, which is where we look to get carried interest from third-party investors when they exit, that has increased by 42% from 27 million to 38 million. Significant numbers. It's a combination of both new investment and growth in the value of these companies. But again, it shows you the benefit of this model. Now, our capital efficient investment model has been at play. Our portfolio companies have raised roughly 54 million pounds last year in a difficult environment. Within that, EMV Capital has syndicated 6.2 million. And what I'll say in our model is that sometimes a little bit of money makes a big difference. A couple of £100,000 can make the difference between having a broader round or not, or helping the company through a difficult spot. So we are quite positive about what has happened last year. Post-balance sheet debt, total AUM has increased to over 100 million. The portfolio is now 70 million. And a lot of this has been enabled by our FCA authorization. We're now directly authorized, which has enabled us to launch our fund practice, both Martlet Capital and an evergreen EIS fund that is now growing as well. So a lot has happened last year. It's been a really busy year. We're quite pleased. Looking at the P&L, group income has increased to 3.8 million, up from 1.8. Now, before I wave the flag, it's important to note that this is affected by a one-off non-cash gain of 1.4 million related to the growth in value of DNAME and the fundraising we brought into it, where we dropped below 50%. So it's a deemed disposal of a subsidiary. But underneath that, there is a really strong performance of the core group. EMV Capital's revenues have increased to 1.6 million from 1.2 million last year. Again, in a difficult year, we've made a profit. EMV Capital's revenues have covered about 50% of the infrastructure costs of the core of NetScientific and EMV. We've also made a cash gain of £500,000 on portfolio exits of 1.4 million. So we are showing that we're able to exit, not only to invest, but we're able to exit our companies. Now, the group loss has decreased significantly to 2.9 million from 3.7 million in 2022. Within that, the core of NetScientific and EMV also has a lower loss of 1.1 million. This is in the context of growing our infrastructure. So again, it's positive. And the portfolio subsidiaries, there is a loss of 1.8 million there, down from 2.5. Important to flag that the portfolio subsidiaries are funded by third-party investors. They're not a draw on our cash. This was not the case a few years back. Today, the portfolio companies are backed by external investors, which enables us to continue with this lean investment approach. Incidentally, that has enabled us not raise funds on the market since June 2022. It is now 2 years since the last placement, and we think that shows the potential of our model. In terms of the direct fair value, we've spoken about these numbers. It is down to 35.6 from 41 million. It has grown 3 times since 2019. The fair value has increased, as I have flagged. It has grown from nil in 2019, end of 2019, beginning of 2020. So quite a transformation. Looking at group net assets, these have declined to 17.1 million from 25. Clearly not positive. However, a lot of that was driven by the decline of value in PDS Biotech over this year and our stake in it. It is also important to flag that NAV, the way it is measured in accounting terms, does not take into account the full fair value of our subsidiaries. So Glycotest, Proaxis, and other things are not fully accounted here in the net asset value. And of course, it also does not take into account the carried interest potential of that 70 million of third-party assets under management. So these are important measures. We very much focus on them, but it's worth remembering that it's not the full picture, and it's important to do your own analysis. Now, if you look at this pie chart a few years ago, you would have seen only several positions, and this really demonstrates the value and impact of our model. We now have a diversified portfolio, diversified in terms of sectors, in terms of portfolio companies, in terms of geographies, and also in terms of stages of development. This diversification both is good from a risk management perspective in terms of relative declines, but also from an opportunities perspective. We have a proactive approach where opportunities happen, we can take those. Having a broader opportunity set means more shots on goal. Incidentally, this comes from data that you will find in the prelims at the end, where there's a detailed table both for the direct fair value and the third-party fair value, so you can do yours. Another way to look at this is the composition of AUM between direct third-party and funds. And you see at the end of the year, direct fair value was 35. It has now grown already towards for the year to date. Oh my God, it's almost half a year to 40 million. But in addition, you can see the impact here of the addition of the funds practice from our capital, composing now the 102 million in total assets under management. I'll talk a little bit about the Matlet Capital Fund mandate. We're very excited. We're not only excited by the great spires of Cambridge and the great architecture of King's College, and even better, the sound quality, but it is what this means. Globally, Cambridge is seen as one of the top 3 clusters where deep tech and life sciences companies are born. It is the birthplace of ARM, the birthplace of many other businesses that are impacting the world today, the birthplace of DeepMind. And we have been working in that ecosystem for a long time, but and also alongside Matlet, but what attracted us was the opportunity of working with a specialist who that is all they do. The addition of Matlet Capital is really transformational to our ecosystem. It is not all about Cambridge, so I'll talk about the future, but through that transaction, we now have deep access to the Cambridge cluster and a specialized team that is all they do. They spot early stage opportunities and build them up. It has added 23 million of funds under management. It is adding additional carried interest, more shots on goal. It is also adding more opportunities for us as EMV Capital and NetScientific to identify companies to work directly with, to deepen our stake, to bring more money to them. But also from a sustainability perspective, it is adding a recurring annual management fee, sub 1 million, but a healthy sub 1 million, and a broader team of really valued colleagues that have now joined our team. Going forward, we'll continue to develop this portfolio, but we'll also look at launching a follow-on investment practice around Matlet. Now, it's important to flag that the way we structured this deal is it is non-dilutive. No paper, no cash, or no significant cash. This is really important to understand with our model that we're looking for good value additive opportunities for our shareholder base and our limited balance sheet. And you hopefully will see more of that in the future. I'm not going to spend too much time on the portfolio highlights because I'll blow through the morning, but it's worth flagging that each of these companies we have been now tracking over several years. We have deepened our stakes in these businesses. With some of them, we have realized some returns, but most of them have had significant improvements over the year. And they are in the growth sectors of today and tomorrow: oncology, industrials, construction tech, respiratory diagnostics, dealing with the plastic waste problem, deep tech recycling. Maybe if I mentioned that, if you recall, a year and a half ago, we acquired the assets of Recycling Technologies out of the administrator, a company that was close to an 80 million IPO with a 40 million fundraise. For various reasons, it didn't work out. That company now is in the process of turnaround. We have raised money for it. We have first MOU signed and clients lined up. So there's continuous value grown with these businesses. Ventive itself experienced a 14 times increase in valuation in 18 months and further progress. So there's some really strong underlying growth in these companies. When you look at the RNSs that we release, you will see where we add fair value with these transactions, continuing to diversify the source of future capital gains and de-risking the portfolio. So turning to our outlook, we will continue to do what we're doing and we'll add a little bit more. First of all, our focus is on growing the value of our portfolio company holdings. We're not sitting on our laurels. This is not an investment trust. We do that through the tools we've outlined: proactive management of the portfolio through board seats. Through the venture partner and advisors panel, we're able to increase the number of board seats that we hold. Selectively engaging on the value creation services side to drive the ambitious roadmaps of these companies. We can't do it for all, but for a select few, we do it, and there's results. Importantly, because we're close to the action, we get to see when we can build the further direct stakes on good terms, and over time, our portfolio becomes more valuable. Secondly, we'll continue to scale the funds practice. I've talked a lot about Monthly Capital Fund. There is a similar growth strategy around the Evergreen ES Fund, and there is other fund initiatives underway. What I will say on that is that we have an international outlook. It's really important. We now have gained a foothold in Cambridge, but there's other clusters and areas of activity, and our fund management strategy is taking that into account. We're also looking at driving our portfolio companies towards exit. We want to do that at a time of our own choosing. It's not exits for their own sake. The right time for exits will differ between the companies. However, we're working with the companies to get them to think about these exits. Who are your potential acquirers? Who are your potential partners? How can we build that road towards successful M&A? Now, we can't do everything, and that is why we're also building a panel of M&A advisors. It will not be the big names you're familiar with. It's boutique M&A advisors that think like us, work like us, that we can work with them to build the knowledge of our portfolio so that when the opportunities come or we decide to drive companies towards an exit, that we have the right partners next to it. We have already flagged that we are planning to dispose of ProAccess, and there's a fair amount of work underway there. There's other similar opportunities that we're building up. Now, on our roadmap, the next point is 200 million AUM. And to get there, we have the components, but we will continue to build a resilient and high-performance firm and team. We have a great team. We have a high-quality team that is really hardworking, really motivated, has the right incentive structures, and a multidisciplinary skill set. We're not a pure-play finance firm. We have a multidisciplinary skill set. That's what you need in this space, a combination of the IR skills, the value creation skills, and the back office skills. All of this is supporting our vision to become a leading VC investor in deep tech and life sciences. It's not just a numbers game, it's also what we do underneath it. Part of that is continuing to drive towards financial sustainability and independence. With the results of this year, you can see where it's going. It's in the positive direction, and we'll continue to drive in that direction. Recurrent fees from board fees and from fund management will certainly help that. And of course, we're looking at exits for super returns. Last but not least, we're continuously looking at keeping the group structure tight, optimizing costs, optimizing operations and risk management. There is an integration process ongoing with the Monthly Capital team that will make us stronger. And we're also looking to streamline the group's branding to create a single firm perception for the market when we have these different investment strategies. So in sum, look, it's been a remarkable year within a very difficult market environment, but our strategy is really showing in these difficult times how we can make a difference. We believe we are on our way to build a sustainable business model. Importantly, we are taking advantage of the ongoing VC industry shift. We're not sitting on our hands. We haven't locked ourselves in a dark room, wake us up when it's all over. On the contrary, the value of tomorrow is created today. We're taking these opportunities the market is giving us that perhaps others cannot. They're not as nimble, they're not as fast, and we're building what happens next. So with that, I'll move to Q&A.
Ilian, Ed, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation. Can I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
Okay, thank you very much. Well, I'll hand over to Ed for some of these questions, but Ed, perhaps the first one, Martlet's relationship is described as investment manager. Does this mean they can switch to another manager if they can choose?
Yeah, that's a great question, and very, very simple, I guess, for us to answer. So we have a minimum 4-year mandate to act as fund manager. We would expect to continue the mandate until we'd completed the task being to find an exit for the Martlet portfolio within the fund's timeframe. So we're expecting a minimum of 4 years, but we're expecting really to be fund manager for the duration of the Martlet fund. We represent in the order of 10% of the Martlet Capital shareholder base. So we have confidence in our connections with Martlet Capital, not only as a fund manager, but as a shareholder. And I think it's also important to acknowledge that excitingly, we've taken over the previous Martlet Capital fund management team who now sit with us. So it's been a very collaborative deal. And whilst, of course, the Martlet Capital shareholders are all free to decide the fate of their manager, we would expect it to be a long-term investment, and that's how we treat it.
Okay. Thank you, Ed. I think another one around Panmure, which is from James, around the research coverage from Panmure and what we expect about their support. So James, there's a research note coming up from Panmure. Naturally, our annual results are a really key step, and that enables them to provide a adequate picture of it. So I would say stay tuned. Another question by James. Great results, but not represented in the share price. What is your plan to get the share price up to a more realistic level compared to your asset value of approximately £2? And this question by James, there's several other questions that are touching on buybacks or relisting in the US and so on. So look, I mean, as you can imagine, in the current market, any leadership and management of an AIM-listed company is looking at what is happening on the capital markets. I would say with our approach, we are able to remain autonomous and independent. We have not had a placing the last 2 years, which we think is quite important. It would not have been fun to do so last year. And we're very much looking for growth. We believe ultimately in the strength of the UK capital markets. It's a contrarian thing to say today, I know. If you open the newspaper, everybody's criticizing what we have. But we have an international outlook. And we still believe that the UK capital markets are a good place to grow. We are, of course, continuously reviewing options, but at the moment we feel comfortable where we are. There's an element also that we feel our story is now hopefully starting to shine through. And with the help of our colleagues at Panmure and our PR Belvedere, we'll be reaching out to a much broader set of investors to tell the story. Ultimately, it's for the market to reflect value. I have my own views as an economist about how financial markets work, but ultimately we believe the combination of consistent delivery of value, which we're doing, and delivering on an ambitious model has to be recognized by the market. There's a question by Neil. Do you have funds available for direct investment into companies brought in by Martlet, and if so, how much? So the specifics of the answer are confidential, but we have a platform there that the combination of what Martlet Capital has, the investor network around that, and the plans for a follow-on fund, Martlet 2, we believe will give a long-term potential for the business. The intention is for the company to continue to grow. Okay. There's another question. So a lot of questions around the AIM market and its efficiency. Do you think the company is fair valued on AIM, and have you looked at possible routes to US listing? Out of curiosity, we have in the past, not in any serious way. Look, we are a UK business, and we are built in that way. I think it's a number of companies have decided to take the jump. I think there's an element of minimum size and critical mass that's needed for that. Some of you know I am on the board of a NASDAQ company, so I've seen how it operates there. I would say that operating on the US markets is very expensive and complex. So we feel comfortable with the current strategy, but of course we always keep things under review. Okay. A question by Colin. You highlight that proactive involvement in your companies is important. How can this be managed for 70 plus companies with proposed growth to 200 million? And there's a second point on carried interest. Ed, maybe if I take the first one and you take the carried interest one. So Colin, on the first point about focus, and this is why we talk about platforms. So once upon a time, we could only manage 5. We have now shown that we can do 20, and we're now comfortable to get to the next stage. However, it requires people, infrastructure, playbooks. The way we're approaching this is that we are building a house with its own style, with its own playbooks, with its own signature approach. And we have built those playbooks and a community of investor director types, venture partners that understand how we operate. So what we're doing right now is that we are adding from our panel of venture partners and advisors, people that have seen us operate. They're coming on board of these companies so that we can monitor a broader number of businesses. But it's important to flag, that we certainly don't intend to have this approach with 70 or indeed 100 companies. Rather, this broader portfolio, it's giving us a funnel of deeply understood opportunities because of the Motley team's work that enables us to pick and choose where do we gain a deeper exposure. We keep talking about a platform. The platform's objective is exactly that, to scale the model that we have. This is what's going to drive a lot of value going forward, being able to scale in that approach. And the last point on this, that is why our next milestone is not 1 billion. Our next milestone is 200 million. It's just about achievable. It requires some further tweaks to our infrastructure, some modest additions to our team to get there. But getting there, we believe, will enable us to double again while keeping the signature approach. Ed, do you want to take the carried interest question?
Yeah, so there's a question asking about carried interest and saying that we continually highlight this, but it seems to be a high-profile target for any sort of future government. I think it's probably just worth distinguishing what we mean by carried interest. We're not looking at it as a receipt by individuals, but rather as a receipt of NETScientific. So any sort of tax consequences of that receipt would be corporation tax and not on an individual level, which is probably therefore not so critical in terms of any future government plans to tackle it on an individual level. What we're really looking at here is a contractual performance fee in the order of 15 to 20% above any upsides, plus sometimes a hurdle upon the value invested by the people whose money we manage. So it's an exciting way to leverage our own direct portfolio. Often we have both a direct interest in a portfolio company as well as a managed interest, and that really is our sort of the essence of our capital efficient model.
Thank you, Ed. There's a question by Simon and James on an update, excuse me, on glycotest, and the question is around the negotiations that they had. Where have they reached? Glycotest is at a very interesting point. They have completed, as you know from our announcements, the collection of the samples and the analysis from the clinical trial. That in itself is a very valuable asset. We believe Glycotest has one of the largest collections of liver cancer samples in the world. In and of itself, that's an amazing achievement, especially because the company was effectively its own CRO. Our CEO, Charles Swindell, has been absolutely incredible in terms of building up a network of KOLs and running those clinical trials, and we are where we are now. I don't want to comment on the on an ongoing negotiation, but it's something that is quite technical and important to get right. Once or should those be completed, the company will accelerate its strategy, and that will also require further fundraising support, where we are looking to line up investors to support the future needs of the company. There's also a question around Raspberry Pi's IPO. Look, I think the Raspberry Pi IPO demonstrates so much of what I have been saying. We've all been depressed about the state of the AI market and where things are and so on and so forth. But here is a great Cambridge story, born and bred there, totally different approach to computing in terms of their open model. It's been built. It's not a flash in the pan, just like ARM. These are not flash in the pans. It's not. I won't give examples of things that happened in the past. These are companies that have been built over many years with a lot of work, a lot of intellectual property involved in it, and this is the sort of good IPOs we want to see on AIM. The fact that Raspberry has had such a good uplift shows that there is appetite on the markets here for these sorts of stories, and it is really very much supportive of our investment thesis about the UK being as a great place to build deep tech and life sciences companies. We're certainly medium-term optimistic about IPOs as a route. Perhaps the market needs a bit more time to develop that. But look, statistically, most of the exits come from M&A. That's a fact. But because we're also a name company, because we have good relationships with Panmure and other brokers, it also means that we can speak to our companies and advise them not to do stupid things, or when is the right time to think about such opportunities. So certainly medium to long term, we see IPOs in the UK and internationally as a route. Probably this year is a bit tricky. Okay.
There's quite a few questions, or a theme of questions relating to NAV and the delta of NAV to our lower market share price, and queries about whether a buyback program would be a useful way of closing that gap. I guess just to sort of tackle a few of the themes within that, a buyback program would obviously need a degree of disposable cash from the company, and for the company to have distributable reserves. We take a view that probably a neater way of closing the gap between NAV is actually why not tackle it the other way around? We're all about trying to grow the value, the net asset value of the business, of our underlying portfolio companies. That's our primary focus here. We have great confidence in the value of our portfolio, and we're always looking to grow that. If we do grow that, then that in itself ought to close the gap. We can substantiate that growth with third-party fundraisings, validating pricing, and of course, the proof is in the pudding. Where we can find an exit for a portfolio company, that crystallizes again and ought to have a direct impact on the delta there too. In terms of how we might better use our cash reserves, we prefer to, right at the moment, given the current market conditions, protect our portfolio where we can by using cash judicially from the balance sheet, both protecting existing portfolio companies and considering a number of new opportunities at any one time.
Ilian, Ed, thank you for answering all those questions that you can from investors. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Ilian, could I please just ask you for a few closing comments?
Thank you very much. Well, look, I want to thank those of you who have continued to support the business through difficult periods in the capital markets. You can see that we are not standing still. We are extremely motivated and driving this company towards a success. We see situations such as you have now in the markets, these sorts of market disjuncture opportunities, market breaks, whatever you want to call them, as the times where new leaders are born. And for us, this is an incredibly exciting. I was about to say the most exciting period, and it is. It is the most exciting period. We're seeing the tectonic shapes, plates of the VC industry shift, and we're seeing we're right in the middle of it, and our model is the right one. We really believe that, and we're driving that with our strategy. We are committed to building a valuable business. It's not going to take a few months. It is a multi-year approach. And in that sense, it's consistent with the areas we're focused on. Deep tech and life sciences take time to build value, but once they do, it changes the world. So we're very much focused in this area. We'll remain focused. We have a great team, and we hope to take you with us on this journey.
Ilya and Ed, thanks for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of NETScientific PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you.